Hello everybody, welcome back to the channel, and today I'm going to talk about why mortgage rates are inverse to mortgage price. Now, it's a very kind of weird thing to imagine, because if you imagine something that's higher yielding and gets you more money on an annual basis, decreasing in value, it doesn't really make much sense, because if you get more from it, why would it cost less? That's just the general thing. It's like a stock that gives you more money. Why would that cost less or something? I don't know, but it doesn't make any sense. Now, the reason for this relationship, I can give you a pretty good example of this. Now, imagine the government is selling lamps. Imagine the government is selling lamps. Now, lamps and the amount of brightness they give off are based by interest rates set by the Fed. And so if interest rates are higher, the lamps give off more light, and if they're lower, the lamps don't give off as much light. And people might just look at a lamp and see it, and they're like, I want one that gives off more light. And I'm going to pay more for a lamp that gives off more light. So you would think, okay, if it increases in light giving off, it increases in value, right? Well, here's the thing. Imagine you buy from the government a lamp that gives off 3% more light, okay? And so you're like, oh my god, okay, so I have this for $1,000, I got this 3% more lamp, I have it. And so you're having it, and so maybe a couple years later, you're like, okay, I don't really want this lamp anymore. And so, what happened over those couple years is the Fed decides to raise lamp brightness rates, and now lamps are being sold at the same price that your lamp was sold to you, but at 5% more brightness. Now, if you're going to sell your lamp, which is 3% brightness, at the same price you got it for, which is $1,000, you're never going to be able to do that. An example of interest rates going up, brightness going up, and value going down. Because nobody is going to buy your 3% brightness lamp for $1,000 when they can buy a 5% brightness lamp for $1,000. Nobody is going to do that. Somebody might buy your might pay $900 for your 3% giving off light lamp, but they're never going to pay $1,000 for a 3% when they can do the same for 5%. It's an example of interest rate or brightness rate going up and the value going down. It's not exactly the value of the bond as a whole, but it's the value of a bond with a specific rate on it. And so that's really just how it goes. And it goes the same way, the opposite way. You have a lamp that gives off 3% brightness a couple years later, and now the government is selling off lamps for 1% brightness. People are going to look at your 3% brightness lamp, and they're going to be like, holy shit, wow, I want that lamp. 3% brightness, I'm going to pay $1,100 for that. Get this $1,000 shit out of my face. I'm going to pay $1,100 for the 3% one. That's what I'm going to do. And so that's pretty much just how it goes. Again, an example of your lamp going up in value as rates of lamp brightness go down. That is an example of that, or the opposite way. So, thank you for watching.